Before we start looking at how money is really created, we need to have a quick look at what types of money we actually use in the economy. There's actually 3 types of money that we use in the economy. As a member of the public, you will only ever have used 2 of them. The simplest form is cash, the £5, £10, £20 and £50 banknotes, and the metal coins that most of us will have in our wallets at any point in time. As you probably know, only the government, via the Royal Mint and the Bank of England, is allowed to create these. If you try to make your own at home, pretty soon you'll get the police kicking down your door at 2 in the morning. So, now imagine that you need to pay your rent and your landlord has an account with a different bank to you. When you log into your internet banking and make the payment to your landlord, your bank has to send some money to your landlord's bank to settle and complete the transaction. Of course, the banks don't want to make these payments to each other in physical cash because carrying all this money around is dangerous, even if they use protected security vans and guards with bulletproof vests and helmets. So, instead, they use a type of electronic money, which is called central bank reserves. Remember that name, because we'll be using it a lot in this video. Central bank reserves are effectively an electronic version of cash, and banks use these electronic central bank reserves to make payments to each other. The central bank reserves are created by the Bank of England. We'll cover how later on, and they can only be stored in accounts that the big banks have with the Bank of England. To get one of these bank accounts at the Bank of England, you have to be a bank. So, as members of the public, we can't get our hands on any central bank reserves. We just have to use the physical cash. So the first 2 types of money are 1, cash, and 2, central bank reserves. Remember that central bank reserves are like an electronic version of cash that only the banks can use to make payments between themselves. The third type of money is a type of money that isn't created by the Bank of England, the Royal Mint, or any other part of government. This third type of money is the type of money that's in your bank account right now. This money is just numbers in a computer system. Bankers and economists refer to this type of money with jargon such as bank deposits, demand deposits, sight deposits, or bank credit. These terms all pretty much mean the same thing and are used interchangeably. They might also be referred to as bank liabilities. This is the accounting term, because this money is a liability of the bank to you, i.e. it's what the bank needs to repay you at some point in the future. Now, in a legal sense, the numbers in your account aren't really money at all. But despite that, they serve exactly the same purpose as the £10 and £20 notes that you might hold in your wallet. It's this type of electronic bank deposit money that now makes up over 97% of all the money used in the UK economy. Less than 3% of the money supply is cash created by the government. And all this electronic bank money is created by banks, as we'll explain now. The balloon model. Let's revisit the multiplier model that we saw in the last video. Remember that it describes the money system as having a base of base money. In the simplified version, the base is made up of cash. In reality, it's not just cash in this base, it's also the electronic central bank reserves that banks keep in their accounts at the Bank of England. But it's true that this base is made up of money, either cash or electronic, that was created by either the Bank of England or the Royal Mint. Now let's look at the top of the pyramid. The rest of the pyramid is made up of the third type of money, the electronic bank-created money. So the pyramid is split up into a base of government-created money and a tower of bank-created money on top. Remember that we said this pyramid in theory is limited by the reserve ratio? Well, there is no reserve ratio, and there hasn't been for years. This means that the total amount of money in the economy isn't really limited. It can keep expanding without coming to a point at the top. So the pyramid is actually the wrong shape to describe the money system. In reality, it's closer to a balloon of bank-created money, wrapped around a smaller balloon of base money. In this case, the base money is the electronic central bank reserves and cash. As we'll see in this video, the Bank of England has relatively little control over the total size of the balloon of bank-created money. They can't really control how much money is in the economy, even if they claim to be able to. The outer balloon of bank-created money could expand out of control and the Bank of England wouldn't be able to stop it, at least not within the current monetary system. We saw this happen before the crisis. In 2006, the outer balloon of bank-created money was 80 times bigger than the inner balloon of base money. The multiplier wasn't 10 times like the textbook models suggest, it was actually 80 times. And then when banks panicked during the crisis and refused to lend, the Bank of England pumped a load of extra base money into the inner balloon through the scheme known as quantitative easing. But this didn't lead to a massive increase in the size of the outer balloon. Right now, the outer balloon, the amount of bank-created money, is only 14 times bigger than the inner balloon. This shows that there is no real connection between the amount of central bank reserves, or base money, and how much money that the banks are able to create. So what actually affects the ratio between bank-created money in the outer balloon and government-created cash and central bank reserves in the inner balloon? What determines how much money is created for the economy? The research that we've done suggests that the amount of money that banks can create is not determined by reserve ratios or by regulation or by the control of the Bank of England. The reality is that the total amount of money depends on the confidence of banks. If they're feeling confident, banks will create new money by lending more. And when they're scared, they limit their lending, which limits the creation of money. So the size of the outer balloon really depends on the confidence and incentives of the banks. Or to put it another way, the amount of money in the economy depends on the mood swings of bankers. Given that the amount of money in the economy can determine the health of the economy, does it sound like a good idea to have such an important thing decided by the mood swings of bankers? Probably not. Okay, back to the numbers in your bank account. These numbers are all created by banks. The vast majority of these numbers were created when somebody took out a loan from a bank. Let's see how this happens. A customer, who we'll call Robert, walks into a Barclays bank and asks to borrow £10,000 for home improvements. Barclays runs a quick automated credit check and decides that the customer can be relied on to keep up repayments on the loan. The customer signs a loan contract promising to repay the £10,000 plus the interest over the next 4 years, according to an agreed monthly schedule. This loan contract is a legal contract that binds the customer to make repayments to the bank. This means that it is a legal contract that is considered to be worth £10,000 plus the interest. Because it's an asset, Barclays can record the loan on its balance sheet. Now, if you haven't come across a balance sheet before, don't worry, it's pretty simple. There's two parts to a balance sheet. One half records all the things that the bank owns. This could be money, other financial products like bonds and derivatives, bank buildings, computers, and most importantly, the loans it's made. How can you own a loan? Well, if someone signs a contract promising to pay you money, then that contract is worth something. It's considered an asset of the bank. In the case of Robert, the contract that he signs promising to pay the bank £10,000 plus interest over the next few years is worth at least £10,000 to the bank, and therefore it is an asset to the bank. So the bank puts an extra £10,000 on its balance sheet like this. Now, what about the other half of the balance sheet? The other half of the balance is what's called the liabilities. This is a record of everything the bank owes to other people. On this side, you'll find a record of money that the bank has borrowed from other banks or large pension funds. You'll also find all the customers' accounts, because if you remember, the balance of your account is just a number showing what the bank promises to pay you when you ask for your money back. When Robert signed the contract promising to pay the bank £10,000 plus interest over the next few years, he did it because he wanted some money from the bank. So the bank creates a new account for Robert, which is linked to his debit card, and just types £10,000 into their computer records. This £10,000 is a liability from the bank to Robert, and it shows up on the other half of the balance sheet. Now, when Robert goes to the cash machine to check his balance, he'll see £10,000, which he didn't have before. All the bank has done to create this new money is type some numbers into an account. It hasn't reduced the balance of anyone else's account, and it hasn't taken any money from some pensioners and moved it into Robert's account. So the process of creating commercial bank money, that's the money that the general public use, is as simple as 1. A customer signing a loan contract, and 2. The bank typing numbers into a new account set up for that customer. This new bank-created money represents new spending power or money in the economy. Robert can now go and spend his money anywhere in the economy using his debit card, checkbook, internet banking, transfers, or even by taking cash out of an ATM.